Great. Well, thank you everyone for joining us today. Today we are going to talk a bit about best practices that are making the difference for consumers. It's been about 1 year since we released the down payment assistance best practices. So this webinar is really going to highlight what we believe are some of the practices that we've seen over this last year that a handful of DPA providers have adopted that we feel are positively impacting consumers, and DPA providers may want to consider adopting this approach or using these approaches given both their impact on consumers and the current market. So today, let me go back one. Today we're going to focus on subordination, reservation of funds, and homebuyer education, and we have 3 different speakers to talk about each. As always, I'd like to just start for those of you who are new to these calls by highlighting a little bit about the best practices and the benefit of these best practices. So as I mentioned, we launched these about a year ago. The best practices were developed by a working group that consisted of people across sectors, including municipalities, DPA providers, those really working in this ecosystem on a daily basis. And really, the goal behind the best practices is wanting to promote standardization and transparency. A lot of the work that we did leading up to creating these best practices, we heard from industry and consumers how confusing it is to access down payment and the barriers that really prevent people from using it and having it be a successful transaction. So in addition to removing those barriers, we also have found that by having best practices, we've been able to make the argument for increasing funding to better meet the needs of consumers. Having kind of a systemic supporting underlying foundation where we're working together and collaboratively and talking about how down payment can positively impact consumers and we can address those concerns has led to a more legitimized approach for current programs, and really down payment being seen as a stronger tool both in the market for access as well as to help reduce the homeownership gap. And finally, we believe by having these best practices as a foundation and doing this work, we are beginning to build a coalition of DPA providers across the state, and believe as we move forward, we're going to see more and more coordination and partnership amongst DPA providers to get these funds out. So with that, I am going to turn it over to Jason Peterson with NeighborWorks Home Partners, and he is going to talk about subordination.
Great, thank you, Brooke. So as Brooke mentioned, my name is Jason Peterson with NeighborWorks Home Partners. We are a nonprofit based in St. Paul, working across the Twin Cities and the entire state for some of our programs. We are the primary down payment assistance administrator here in the Twin Cities as a nonprofit. We provide down payment in partnership with municipalities as well as utilize our own funds for this work. We close roughly 300 to 400 down payment loans in a given year. And today I'm here to talk about subordination. So I just want to start with some real basics here. So, when a loan is closed, a lien is filed, and the mortgage lien provides the lender with financial claim to the property and ensures there's collateral until the debt is repaid. If there are multiple mortgages or liens on a property, each has a specific lien position. So these liens are then ordered. So mortgage subordination, that really refers to the order of the outstanding liens on the property. So why this is important mostly for lenders is in case of a default, the liens are paid based on their position. So first lien position is paid first. So lenders want to be in the highest lien position possible, and first mortgage lenders almost always require being the first lien position. Next slide, please. All right, so Second mortgage loans, including down payment assistance and home repair loans, often hold the lower lien position than the first mortgage loan. This occurs 99.9% of the time. So again, lien position matters during a default, and it also comes into play when refinancing a first mortgage. So when you refinance a first mortgage, typically that first mortgage loan then would be placed in the last lien position. And so that is not something that a lender will allow. And so this requires approval and subordination from the other lien holders to allow that refinance first mortgage to then enter into first position. First mortgage lenders really will not allow a refinance to occur unless they are moved back into that first lien position. So effectively what this means is a subordination allows, when a refinance occurs, a subordination allows that lien. So a lien, the lien order is generally determined by the time and date of recording, the order of recording. And so if you have all these liens in place and you refinance, that's going to occur after these liens are already recorded. So in a typical process, that refinance lien would go into the lowest position. So a first mortgage lender is not going to allow that. And so what subordination allows is for that first mortgage to jump ahead of the line and take that senior position. So, why this is important is, we've been talking a lot about down payment and down payment best practices. This also comes into play with home repair loans, but you'll often see deferred due on sale loans that are sitting as these junior second mortgage liens. But it will apply to any junior second mortgage lien. And so what this subordination allows then is it allows for that first mortgage when it's refinanced to move to that first position, but there needs to be approval for that process. And so today we're going to talk a little bit about what that looks like and why that should occur. I do want to talk just a minute about what this doesn't mean. So when a subordination occurs and you have this first mortgage lien that then jumps the line, basically, this does not forgive, satisfy this second lien. So this second down payment, the second lien that might be down payment or home repair, that the amount is not reduced, that amount is still owed. And really, generally speaking, there is no impact on the collectability of this lien. There can be a concern regarding what the specifics are on that new first mortgage, but really generally speaking, I just want folks to be clear that if you subordinate a second mortgage, you're not satisfying that lien, you're not reducing the amount owed, and you're really not impacting the collectability of that lien. Next slide, please. So then why? Why does this matter? Why is this important? So if you have a second mortgage, say a deferred down payment loan, and somebody has a first mortgage and the interest rate is quite high and they would like to refinance to a lower rate, and they come to you and say, I would like you to approve a subordination of your lien, and you say no. At that point, then the first mortgage that they're looking to refinance with, they're not going to approve that refinance. So then you're going to have that borrower where you have a second mortgage loan that may be locked into that higher interest first, or if they have an FHA loan with life of loan private mortgage insurance, they're not going to be able to get out of that. So this can potentially have a huge impact for borrowers. If you don't allow for the subordination, the borrower is likely not going to be able to refinance. Another piece of this is paying off other mortgage liens on the property. So there are times in which a refinance is going to be beneficial, not just for rate and term, but also to utilize equity to pay off other liens. And then that last point on there, if somebody's unable to refinance, they might just have to stay with their current first mortgage, which might not be the best financial decision for them, or they might have to move. And so again, while it might seem like a small thing, we're not going to budge on our lien position. It can have a major impact on folks. Next slide, please. So with that, so again, what's important here is If you have a junior lien, to be open to the idea of the subordination opportunity for folks to be able to, in most cases, refinance their property. That being said, you can put conditions around the subordination. And so we have these in place for our organization. And I would suggest if you're looking at the possibility of providing providing subordinations, that you have some of these conditions. So one that we have is the refinance needs to be for economic reasons. So lowering a rate, change in note, or prompted by a life event. So one thing for most of our programs, if somebody is just looking to at a cash out refinance and take a lot of money out, we often require repayment at that time. So often, there needs to be that economical reason, and that's that second point as well. We limit the cash back to the homeowner. And you can predetermine that amount. It could be less than 1% of the new mortgage. It could be $2,000, whatever that might be. With the thought being, if somebody is going to take a lot of cash out, then they do have the opportunity to pay off that junior lien. One thing that I'll note that's becoming more and more important is folks are getting into properties, potentially higher interest rates, relatively speaking, and need some additional work. We have carved out an exception when cash out is related to home repairs and home improvement to allow folks to be able to utilize those dollars so they can make those repairs. Another condition that we put in place is we do maintain the current lien position. So let's say there's a first mortgage and we're in second position. And so a refinance occurs, that new first mortgage, and let's say there's a third under that. So there's a first mortgage, we're in second place, and then there's another down payment that's in third place. What we do require is that we maintain that second position. So there'll be a new first mortgage lien holder, but we maintain that second position. And then we do prohibit reverse mortgages or private party transactions within these subordinations. So in the end, subordination, while it might seem like a small thing, it can have a huge impact for borrowers in certain places. So if you're considering down payment or home repair or other second mortgage lending, we would strongly encourage you to adopt a subordination policy in line with these practices as a best practice so you can support the continued ongoing success of these borrowers. One thing that's important for us as a nonprofit supporting homeownership is that we're not a detriment in the future to the borrowers that we work with, and we don't want to be an impediment to their continued success. And so ensuring having a subordination policy in place ensures that they can make good financial decisions and refinance their first mortgage without any challenges in place from that second mortgage. And that's what I have. Thank you.
Hey, Jason, can I ask a few questions?
Yeah.
So one of the things that I hear from DPA providers is this is a lot of work and it creates kind of a administrative burden, would be the first question I would have. Secondly, what are your thoughts on programs that have closed down payment? The agreement is in place, they didn't allow subordination, and now this is kind of becoming a factor. Do you think that there's room for them to make an amendment to that mortgage and note? Because I think a lot of programs don't allow subordination, and I think with the notable change in the market, for a long time, interest rates were so low that it was kind of a non-factor and it kind of fell off of a lot of radars. And as I said, administratively, burden is some of the pushback. But now you've got people who've maybe been locked in this last year to 7% rates this summer. Some are predicting will go back down to 5%. I mean, that's a huge savings for a lot of people. And there is the potential that we might even get lower than that in the future, and some might come back for a second refi in a year or two. So just wondering if you can kind of talk about the burden and then how you would maybe think about how some might approach allowing this for mortgages are already closed that didn't allow for that.
Sure. Yeah, those are great questions. So on the administrative burden side, they are not very burdensome at all. What's important to have in place is your guidelines. And so really just laying out clear guidelines. And if anybody on this call is interested, we would be happy to share the guidelines we have. And then once you have guidelines in place, and so specifically, that's going to look at some of these conditions. And so using as an example, we have a limit on cash back. And so you have that amount. And so it's not really a subjective, when you're processing these, it's not a subjective piece, it's really objective. So you're saying, does this meet our criteria? And so you're going to have a request that's going to be made by the borrower. You're going to need information on the new loan from the first mortgage lender. But once you have that information in place, it's quite easy to process. So generally speaking, it takes maybe an hour to get through. And so it's really not administratively challenging. I did see a question in the chat from Bethany on a subordination fee. We do charge a subordination fee. It's $150, I believe, is what we charge right now. That's really for the time it takes for us to review and to do what we need to do on our side to approve the subordination. And that's a very reasonable fee that most folks charge to do. I will note that we do administer programs on behalf of a number of municipalities. And what we do is we make sure that we have clear guidelines with those municipalities. And then folks either meet them or they don't when they apply for a subordination or request a subordination. So really, there's not, again, any subjective questions about these. It's really an objective piece. And so the administrative burden is quite low. And I would hope that that wouldn't be a barrier for folks, because you're looking at maybe an hour, maybe 2 hours if you need to follow up with folks. As far as, and thank you, Bethany, for it looks like Habitat does as well. So about $150. As far as adding that into place, unless your documents explicitly say otherwise, you can allow for subordination if it's silent to that. We do include, as a best practice, a subordination policy when we close down payment loans, and most of our municipal partners do as well. But that's not a requirement to allow for subordination. And so, if you're working with somebody or your program in the past has been silent to that, it does not mean that subordination is not allowed. So as Brooke mentioned, it does sound like rates will be dropping. And again, you have folks that need to make some home repairs. There's a lot of reasons that folks need this. And so just because you haven't had anything in place, it doesn't mean you can't start to allow this. And so what I would encourage folks to do again is to just make sure you have the parameters in place, utilizing best practices. And then if you're working with a down payment provider, you can delegate them the authority. And so you're not even necessarily needing to know that this is occurring, because it's not really impacting the collectability of your lien in any way.
Thanks, Jason. Very helpful.
Yeah.
Any other questions before we move on to the next topic, reservation of funds? People can feel free to continue to use the chat or unmute either way. All right, let's turn it over to Casey to talk about reservation of funds.
Hi, everyone. I'm Casey Ware. I'm the Director of Lending at NeighborWorks Home Partners. Today, I will be going over the reservations of funds, the benefits of reserving funds for a down payment program. Right now, we have about 4 different programs that we do offer pre-approvals for, so you can reserve the funds ahead of time prior to finding a property. The benefits of doing this is it increases the confidence in the buying power for the borrower. They can actually negotiate with their purchase contract, knowing that they have already been pre-approved for down payment assistance funds. So that gives them the peace of mind that they need when going into negotiations. So also it accelerates and streamline the closing, because we have done all of the processing up front. We can sometimes depending on the time frame and receiving documents and things, we can, from the first mortgage lender, we can possibly close earlier than our typical closing time. And then it's a greater predictability for the use of funds. So they're kind of like guaranteed the funds. Next slide. Some of the conditions for fund reservations, the borrowers must first have a pre-approval from their first mortgage lender. So they have to have that pre-approval. Some of our programs do require that they have a home buyer education or financial wellness prior to entering into a purchase agreement. So we would need to see that, depending on the program that they are applying for, they would need to have that home buyer certificate submitted along with that pre-approval first mortgage letter. And then we can start the process. So we still collect all of the upfront documents, pay stubs, bank statements, ID, and things like that in order to go through a process as if they had a property in order to get the pre-approval. Once we have them pre-approved based on the income, based on the asset limits and all of the different guidelines that that particular program may require, then we can issue them a reservation letter that is typically good for about 90 days. This do give them a time to actually search for a property in that area that their pre-approval is good for. So they have 90 days to enter into a contract. It could be on the 90th day that they find a property, and that will be totally fine. Just need to get a fully executed purchase agreement on that day. Also, with reservations of funds, once we get the purchase agreement, as long as it's within that reservation period, we do not have to recertify them or collect any other supporting documents. So once they're pre-approved, they actually approve unless their first mortgage fall through or something is wrong with the property and they cannot close a property outside of the area. So again, funds are pretty much guaranteed as long as the first mortgage is able to proceed with the first mortgage. So it's a benefit of being pre-approved ahead of time while searching. As I said earlier, give the borrower peace of mind, just knowing that they do have these funds already waiting for them. So, any questions? I think that's all.
Thanks, Casey. And I actually think you find, I think you still, this is, so the shift in this and all the things that you just said, Casey, and the thing that you mentioned that I just want to raise up as well is that this is like a new way of doing down payment assistance. And there are still a lot of players in the transaction, whether that be the seller, the agent, who really are resistant to accepting offers with down payment because of the experience that they've had where when it's time to, go to closing, the funds have run out, they're no longer available, they may not qualify anymore. And so this really does mitigate and helps to not only empower the buyer in the transaction, but also helps to kind of change the conversation about down payment and the value it brings to the transaction. We do have a question in the chat. By pre-approving borrowers before they've signed the purchase agreement, what percentage of those borrowers end up going through the program versus dropping out? So kind of what's the conversion rate, right? Because like you said, Casey, you're doing a lot of upfront work. So how many people actually are able to make it to purchase agreement versus kind of having to, never making it there or having to start over?
Yeah, so what we see, because we don't do like a lot of pre-approvals, because a lot of our borrowers do come in with purchase agreement, but out of the pre-approvals that we do have, I would say about 50% of them drop out, 50% of them do close. The benefit of this, what we see in the dropout is because a lot of people may enter into a purchase agreement and that property inspection does not come through as what they thought it would come through. So the benefits of having funds reservation, it do give them opportunity to enter into another purchase agreement as long as it's within that valid reservation time. And so so we do see that a lot of borrowers will find another property prior to it expiring. And then sometimes it's just hard with the market that we're in now. It's just hard for them to find an affordable home within that time frame. So they end up expiring out.
So with that 50%, would you say that that's for the example you just gave, where some people actually have to cancel a purchase agreement through no fault of their own? Do they count in the 50% that are successful?
They do count in the 50% that are successful if they go
Okay.
on to close. But then
Okay.
we also have some that doesn't come back, that don't
Right.
come back with a purchase agreement. So
Right. And we have another question about what if the funds run out before the 120 days is up? And part of the reservation process is that the funds don't run out, because essentially what you're saying is that these are their funds. So Casey, could you talk a little bit, or Jason, I know you've talked about this previously too. One of the challenges of reserving funds is that you can actually kind of create a little bit of a backlog or like a barrier, right? Because you have these funds held, and you can't give it to another borrower kind of in waiting until that reservation period ends. So I don't know if you can speak to that a little bit, Casey.
yeah, so so that's actually a challenge that we're experiencing now with some of our programs. So we may have borrowers that's holding up funds, been about 60 days, they're not moving or anything, but we have run out of funds for that program. So we continue to have to turn borrowers away while we wait on that particular person that's holding the funds to find a property. And as I said, 50% of them may not find a property. So now we have passed or had to turn away maybe 5 to 8 borrowers. And then once these funds expire, now we can re-lend those or put them back out. And now we may not have, or we just gave up on 5 to 8 borrowers or potential homeowners that needed these funds. So it's some challenges to it as well. So we're not serving as many customers as we possibly could, especially to some of our, as quickly as we
As
could.
quickly. Yeah.
Yeah. And
Yeah.
I would say like some of our programs, you can reserve up to a certain amount. So we may reserve up to a certain amount, but then they don't take that full amount. But because we had a reserve for that amount, we was holding up too much of the money.
Right. And from what we have heard, it seems like this tends to be more of a problem with smaller funds. Like if you can only do 10 or 15 down payment loans, this may not be the best strategy. Or when you have larger programs available, let's say you're doing, 100 down payment assistance or 50 loans a year, then it usually runs smoothly until you start to get to the end. And I think that one of the opportunities then is, let's say you've got 10 reservations held up. It's, where are you at? Or, asking people, do they still see that they're going to move forward with the transaction? People can opt out earlier than the reservation period, et cetera. So no perfect solutions, but definitely more ideal for programs that are a little larger in scale, which is also why we kind of keep the 90 to 120 days so that the funds are not perpetually kind of held. And I think it depends on the program, right? I think some programs probably have a higher conversion rate and other programs probably have a lower conversion rate in terms of the number of people who go from pre-approval to closing. All right. Any other questions?
Look like we had another question. A person can reapply once the funds expire. They can also reapply.
In most of those instances, they kind of have to get back in line though, right? Unless it didn't go through no fault of their own.
Yes. If we have pending applications, then yeah, they wouldn't be able to reapply. As long as we don't have any pending, then they can reapply.
Great. All right. So it appears that our next speaker is unable to join us. And so I am going to just pivot and move us to the end. And so questions and discussion, I think we've been having some great ones. So I'll give it a last call for any additional questions about these topics. Again, I think both of these are very important given the market. And while they're not, without challenges, I think in most instances are beneficial to the consumer. in the home buying transaction. So I'll pause for a second and see if there's any other questions. Okay, well then I'll just take a moment to just say that our next meeting will be held on Thursday, March 14th. The link is currently available on our website for registration. I will send out that registration link probably early next week, along with the recording of this webinar, just because, you know, I'd like for you to share it with peers if you found it to be beneficial or helpful for them to know if they were unable to attend. And I will say that there is going to be a lot of conversation about the first generation down payment assistance coming to market, both the Community Fund and Minnesota Housing Fund. There are going to be a lot of trainings on these products in February, March, and probably April. And I just want to be clear that we are going to talk about the terms of the product. We are going to talk about how it's built, but the focus of this webinar is going to be a bit more on kind of the strategy behind this program and what the opportunity is to kind of disrupt and transform the down payment delivery system. So as DPA providers and people who work in this space in proximity to supporting these programs, offering these programs, talking a little bit about it more at a strategic level and what this could mean as we move forward. I mean, this is a historic investment in down payment assistance. This is first of its kind, unique statewide program that will be available to be used with any first mortgage. And so I want to talk a little bit about the kind of the why and the what and what we hope to see be different and what the opportunity might be as we move forward to kind of work together collaboratively as a network to continue to have investments like these be made in our state. So that is what's to come in March. And so again, you can register now online at our website, and I will also send out the registration link early next week. So with that, I thank you for your participation in this new year of this meeting today, and look forward to seeing people on future calls throughout the year in 2024. And thank you to our presenters, Casey and Jason. I appreciate it. It was great information.